and good evening. So today we are hosting third episode of our webinar series, Mastering IFRS in Today's Reporting Environment. Our guest today is Mr. Ayaz Mustafa Saab. So I will give you brief introduction of the Ayaz Mustafa. Before that, I would like to invite Zia Mehboob Saab. He is ex-bureaucrat, so he will give us welcome note before starting the webinar. So Mr. Ayaz Mustafa, Ayaz Mehboob Saab, Zia Mehboob Saab, thank you for joining us. So can you give you, it is over to you. So please, sir.
Assalamu alaikum. Welcome all. Thank you, Fahim bhai and Ayaz bhai, your efforts, and the ICMA, Hira, your all efforts, and putting all this together. Mashood bhai, I have the honor of knowing Mashood for so long and working with all you guys coming along. So I welcome you all. This is the third series of the IFRS, and Ayaz bhai has worked so hard to make this beneficial for you, for all of us, and to benefit the entire ICMA community. And I welcome you. I hope you will gain a valuable knowledge and insight on the IFRS in this session. And this is the third series, as I said, and there will be a next one, be the last one, which Yazbhai will be concluding. And this session will be very helpful for you guys to apply all these standards with authority, with confidence in the workplace where you basically you work and you apply. And this will enable you to talk in confidence, face the scenarios, the situations. So all this is a great effort, and hats off to Ayaz Bhai and the coordination of Mashood Bhai and Fahim Bhai, all of you. And I hand over to you and welcome you all. Hopefully you will have a very good and interactive session. Thank you. You are mute, Fahim Bhai. You are mute.
So thank you, Zia. Thank you very much. So I would like to invite now our respectable speaker, Sir Ayaz Mustafa Saab. So Ayaz Mustafa is Head of Accounts in HBL Commercial Investment Abu Dhabi, UAE. With the extensive experience in finance and accounts, he brings deep insight into practical application of IFRS standards. So thank you, sir. You have already given us so much information, knowledge, and understanding of IFRS in last two episodes. So this is the third episode. For the you are bringing IFRS 15 and 13 on table today. So without any delay, I will give the control to you, sir. It's over to you. So for the participants, you can give us your questions in the inbox. You can write. So I will read it out for you, and sir will give you a brief reply accordingly. So it is over to you, sir. Thank you very much for joining today, and you can start now.
Bismillahirrahmanirrahim. Thank you so much, UAE Branch Council and the Saudi Branch Council for conducting this series on webinar. As the worthy anchor told you people that today is our third session on the IFRS. And whenever we talk about any IFRS, especially IFRS 15, so revenue recognition, every entity is concerned and very much conscious about the recognition of the revenue. But IFRS 15 is a very vast standard, and same is the case with IFRS 13, fair value measurement. So the depth of our today's webinar will be covering almost all types of entities, as well as all the basic concepts and the advanced level concepts I will discuss with you people today. Inshallah, you will learn and you will revise all the standards that many of the people are doing these things unknowingly without knowing that the standard is also the same thing. So application of IFRS is already based on the logics. So I will try my level best to convey all the things with ease and clarity. So let me share my screen. I hope screen is visible. So when I was deciding that what to cover in IFRS 15, revenue from contracts with customers. So as the theme of the series is mastering IFRS in a world of evolving transparency. And I focus on in every session that with the passage of time, financial transparency is getting very important in this environment. So, yes. So let's start IFRS 15. First of all, basic introduction. Theme of IFRS 15 will start from the basics, then intermediate level, then advanced level. So first thing, what is the objective? Prior to IFRS 15, there were two standards, IAS 11 and IAS 18. IAS 11 was related to construction contracts and IAS 18 was related to revenue recognition. That when all of us were students, we have studied these things. But now both of the standards are replaced with IFRS 15, revenue from contracts with customers. So the purpose or the objective, we can say that of IFRS 15 recognize the revenue to reflect the transfer of goods or services in an amount that reflects consideration expected. So basically standard says that our aim is to recognize the revenue of goods and services in a way that we are expecting to receive. So what is the need of change? So IFRS 15 was created to replace and merge IAS 11 and 18 because the old standards were. So what was the drawback in the old standards? They were inconsistent, outdated, lacking the guidance for the complex contracts, difficult to apply across the industries, and they are also not globally aligned. So this global revenue standard is with better comparability. So in the last standards, if you remember IFRS 18, it was too much focusing on better comparability, improved transparency. So all the standards which we are getting nowadays, their aim is to improve the comparability, improve the transparency, and more detailed rules. So it replaced IAS 11 and 18, applies to all industries. So this one single standard is applicable to all industries. So prior to this, there were separate standards. And focus on the control, not risk and reward. If you people remember that previously there was a term that the revenue is recognized when the risk and rewards are transferred. Now the standard is using the word control. So when the control is transferred, we will be recognizing the revenue. So there is a very famous thing every interviewer is asking, what is the 5-step revenue model? And everyone is answering that there are 5 steps. Today, I will try to inculcate all these 5 steps with more clarity. So if you see on the left side, there are 5 steps, step 1, 2, 3, 4, 5. So first one is identify the contract, then identify the performance obligation, determine the transaction price, then allocate the transaction price to performance obligation and recognize the revenue. So this slide is basically covering the whole standard. So all the next slides will be the explanation of these points. So whenever we say that there is a contract, so what will be a valid contract approved by both parties? Rights of each party is identifiable, payment terms are identifiable, and there must be a commercial substance, and there is a probable collection. So if these criterias are met, so we can say that there is a valid contract between the parties. And once the contract is there, there must be the second identification, performance obligation, that what they have to do. So there must be distinct goods or services. So everything must be clear that what you are going to receive or what you are going to provide. So what is exactly the goods or services? Either a single or a multiple obligation. So if there is only one unit or only one order having multiple units, so that is a single obligation. Or sometime it is step by step. So all the next slides are covering all these scenarios. And sometime in a performance obligation, there is a bundle. Sometime there is a separate services. So the services could be distinct goods or services, single or multiple, and bundled or separate services. So all these 3 types of the performance obligation. So once you have identified the contract, once you have identified the obligation, now the next step is to determine the transaction price. So whether it is a fixed price, most of the time we have fixed price contracts. Sometimes we have the variable consideration as well, depending upon certain situations. So I will explain one by one the fixed, variable, then discounts, rebates, and bonuses. So sometimes these type of the things are also in the contracts with the customers. Then significant financing components, very important element of IFRS 15. So the price could be any of these 4 bullets. The next is allocate the transaction price to performance obligation. Now, the main thing after recognition of these 3 steps is to allocate the price, that if it is a bundle, how much should relate to this one, how much should relate to this one. So I have a practical examples with you. So I will link that how to allocate the transaction price. Based on the standalone selling price, so there is a concept or there is a terminology in the standard IFRS 15 is using again and again, standalone selling price. So standalone selling price, what is the meaning of that? I will explain. Then allocate the transaction price proportionately. So sometimes we need to allocate this proportionately and sometimes we use the estimation method. So all these steps I'm going to explain in details. Then after doing these 4 steps, the last step is to recognize the revenue. So it means to debit credit. So when recognizing, is it a single time or over the time? So there are 2 types of the revenues, over the time, at a point in time. Over the time revenue, if a customer benefits continuously or controls the assets or the asset has an alternative use and right to payment, or at a point in time revenue if the control transfers at a moment, for example, delivery, possession, title. So it is a point in time revenue. So I will give you the examples focusing on all these 5 steps. So as I told you that allocation of the transaction price to the performance obligation is a little bit technical. So first of all, we must understand these things. As far as a standalone sale price is concerned, a standalone sale price is the price at which the company would sell a good or a service separately to a customer. So normally when we are purchasing the routine items, so this is the scenario. So in this regard, the rule is to allocate the transaction price in proportion to each item's standalone selling price. When the standalone selling price is directly observable, use the entity's normal selling price. And example. So what is the example? A phone sells for 81,000 alone. So it means if I buy a phone, so it is 1,000, and a service plan sells for 680 alone. So it means we have identified 2 things. One is the cell phone and another one is the service plan. In separate, so standalone selling price of both things. One is the good and one is the service. Now, let's make this illustration in more detail. If a customer buys standalone a cell phone, it is 1,000. Now there is a 12-month service plan. So standalone price is 600. So it means in total it is 1,600. But the company offered a packaged price. If you get both the things, so it is in 1,200. Now, if a customer agrees, so there is a contract, there is a performance obligation that the company will give the phone and the service for the 12 months. So there are 2 performance obligations. Now, out of this 1,200, how much should be the revenue associated with phone and how much should be the revenue associated with package, service package? So it means, first of all, the standard says that what is the standalone price? So the standalone price of both items is 1,600. Now, how it will be apportioned from this 1,200? So basically, in the total of 1,600, how much is related to phone? 1,000. So you will calculate a ratio. 1,000 over 1,600. So there is a proportionate. And then you will multiply with 1,200. So you will get 750. So it is the revenue that is related to cell phone. Out of 1200, 750 will be the revenue related to cell phone. Now, the remaining, the balancing figure 450, or you can calculate 600 over 1600 into 12. So it means whenever companies are offering a packaged one, so there are two performance obligations. One is to deliver the cell phone, other one is to deliver the maintenance or any type of services, maybe your internet package or your calling package. So that is 450. So you can not say that the company is giving discount of 400 on phone. No. So 1600 as a separate, and but if you will get as a package, so it will be 1200. So out of this 1200, how much is the revenue related to phone and how much is the revenue related to services? Now we have allocated the transaction price. Now recognize the revenue. As far as cell phone is concerned, it is immediate delivered. So that is a revenue recognized at a point in time. So you will recognize the revenue of 750 immediately because you have transferred the control. And the services 450, it will be recognized over 12 months. So I hope my 5 points are clear with the help of this very simple example, that first of all, identify the contracts, identify the performance obligation, determine the transaction price, then allocate the transaction price, and in the last, recognize the revenue. So contract, performance obligation, there are two performance obligations in this simple example, phone and the services. Then total price standalone is 1600, but as a package, it is 1200. Now, out of this 1200, how much is allocated to phone and how much is allocated to services? So I hope everyone is clear. Now, coming back to a scenario when standalone sale price is not directly observable. As I told you a few minutes back, that I will be explaining step by step. So from basic, intermediate level, then advanced level. So please be with me to understand all the things. So the basic is clear. Now, the standalone price is not directly observable. So IFRS 15 allows estimation methods. So there are three methods. Now I'm going to explain these three methods. First one, adjusted market assessment approach. Second one is the expected cost plus margin approach. And the third one is the residual approach. So instead of reading the slides, I will just go to the example. The slides I will share you at the end of the webinar as per my routine. So you will get it in the WhatsApp groups. So let's go that how you will be calculating the price if the standalone pricing is not there. So there are three ways to estimate it. So first, second, and third. So now the first one, adjusted market assessment approach. Scenario. A company sells smart home security packages that includes security cameras, 1-year monitoring services, and mobile app license. The mobile app license is not sold separately. So it means if the company is not selling it separately, so the standalone price will be difficult to determine. So its standalone price is not observable. What market information we have? Competitors sell the similar app license between this to this per year. So this is the competitor's price they are offering for this. Company pricing strategy. The company position itself 10% cheaper than the market average to attract customers. So first of all, what is the average? Take the sum of 2, divide with 2. So average price is this one. And company's strategy is to give 10% discount to attract the customer. So it means they will be charging 90%. So it means the adjusted standalone selling price will be 45. So the result is standalone selling price of the mobile app license is 45. So I hope that you got the idea that whenever we don't have any standalone selling price, we can estimate. So how we did this estimation? Adjusted market assessment approach. So as the name suggests that we will assess our price based on the market prices and our pricing strategy as well. So average prices of the market competitors for the same thing for which you don't have the standalone price. So I hope everyone is clear with the first method. So there must be a strategy that what is yours. Sometime if you are a very good company, you may charge a premium as well. But now it was 10% cheaper. So that's why I have given a discount. But if the strategy is to charge 10% premium pricing, so you can increase the price by 10% as well. So all depends upon the company's pricing strategy. Now, expected cost plus margin approach. This is very simple for management accountants. A company provides a customized installation services for its equipment. The installation is never sold separately. So again, whenever there is a such scenario, so it means standalone sale price is not available. So what is that? The cost we are incurring? There is a labor cost, there is a material cost, there is overheads. So the total cost incurred on this service is 200. And company's normal profit margin is 25%. So cost plus 25% as a profit. So it means standalone sale price will be 250. So installation services using expected cost plus margin, so it will be 250. So again, second scenario, when you don't have the observable standalone selling price of anything, so you can estimate if you are incurring some cost, again, you can add 20, 30, whatever your company's pricing strategy is for these type of contracts. Now, residual approach, as the word suggests that whatever is left, so that is residual. Let me explain you the scenario. A software company sells a bundle consisting of, so there are three things: standard software license, hosting services, and advanced analytics module. Because nowadays AI is there, so everyone is selling software license, hosting services, as well as AI analytics module. So price varies significantly and is not observable. So known standalone selling price. So we know the license cost, we know the hosting charges, but I cannot estimate analytics module cost. In a bundle, they have offered me 1000 USD. Bundle selling price. Bundle mean combination of three. They have offered me 1000. Now, if they are sold separately, 500 plus 200, so 700. And they are charging me 1000. So it means it is understood that whatever is left, that is for third part. So this approach is known as residual approach. So I hope that whenever there is no standalone selling price, we can estimate the selling price of non-observable element in our contract. So there are three methods. So I have explained all these three methods. So these were the three methods in that instead of reading the slide, I just go to the illustration. So I hope everyone is clear with these concepts as well. Now, one comprehensive illustration, allocation of the transaction price using all three standalone selling price estimation methods. Company Tech Pro sells a bundle package consist of the smart home hub, hardware device. The standalone price is 400. Professional installation services not sold separately, no market price exists, cost information available. So it means this is the element for which you don't have the standalone price. Premium mobile app license 1 year, similar apps available in the market. So it means market competitive adjustment, you should do it. So this is the first method. This is the second cost plus method you will use for this element, and analytics you will be using the residual approach. So in one example, there is four elements in actual. One is known, the other three are not known, but the hint is there That's how you can estimate. The bundle price is 1000. Now, the same data I'm using, that there is a range of 45 to 55. So 10% above the market. As I told you a few minutes back, that sometimes you charge a premium. So now 10% above the market. So 50 is the average. Now they are charging 10% higher. So 55 will be the standalone price of this license app. Then estimation approach, labor, other costs. So total cost is this one, 30% as a profit margin. So 30% of the cost they are adding. So the standalone price of this installation is 221. So now we are aware of these two, and one we already know. So it means 400 plus 55 plus 221. So if we add these three and subtract from the 1000, so that will be the residual standalone price of AI analytics add-on. So it means it is 324. So in a package of 1000, we can segregate these things. Now, the main fourth step, allocate the transaction price among these four components. So how to allocate this? Out of 1000, how much is the share of first one? So the percentage will be 40%, 400 over 1000. So it means 400 over 1000, 40%, 40% of 1000, 400. What is the second? 221 over 1000. So 22.1%. Now take the 22.1% of 1000. So it is 221. Then the third one, 55 over 1000, 5.5%. So that is 55. So if you add all these, so it will be 1000. Now, the device you are delivering immediately. So that is a point in time. Recognize the revenue immediately. Installation is again, is this one-time installation, or is there any contract to have the benefits of these services if it is for 1 year? So in this example, it was written that over 1 year. So it is a customer is getting the benefit during installation. So it is over time. Then license is again 1 year, it is over the time. And AI, if it is a one-time installation, then it is a point in time. But if you are getting the AI analytics step by step over the year, so that will be over the time. So it is the summary that how to recognize the revenue as per the provisions of IFRS 15. Any questions so far? Let me see if there is any question. Okay, people are asking for the WhatsApp group link. There is no specific group available for this one, but at the end I will show you the number. You can ask me, and otherwise in ICMA members group, I am always sharing. Okay, so there is no question so far. So let me proceed. So I hope everyone is clear with these things. A very simple example now. First step, 1000 units of a 1000 units to a customer with a 30-day payment. So contract is there. Performance obligation, deliver the 1000 units only one time. So it's a single performance obligation, nothing attached, nothing installation, no. What is the price? So it's a fixed price contract, 50,000. So in this case, no allocation, because there is only one performance obligation. The allocation will only be there when there are multiple performance obligations, just like to deliver the device, installation, then AI analytics. So many things. So there might be multiple performance obligations. And then in this case, you will be recognizing the revenue when the control passes. So when the control is passed, when you deliver the products. So that is a simple, very simple scenario as compared to the previous one. Now, some industry specific questions like how to deal the revenue in the real estate, how to deal the revenue in manufacturing, how to deal with IT companies. So I have a few examples there. So in a real estate developers, so off-plan units, so what are the issues? Is performance at a point in time or over the time? Are the payments milestones or the revenues? And who control the asset during the construction? So if you are constructing, sometimes customers are also paying you. So what is the correct IFRS treatment? Real estate developer revenue can be over time, mean 2 year, 1 year, 3 year, whatever is the time of your plan. And point in time as well. If the control only transfers at a handover. So you can recognize point in time revenue when the control is transferred at the time of handover. So let's see a few examples. Let's say there is a payment plan 50-50. So 50% construction and 50% the customer will be paying at handover. Total price is 2 million. So during the construction, client does not control the asset because the asset is normally controlled by the client when he is getting it. So that is a handover time. So at this time, there is no revenue. If you remember the first slide, I have written that the revenue will be recognized when the control passes, not risk and rewards. So that is a control is transferred or control is taken by the client at the time of handover. So the construction stage, it is not a revenue. And at handover, you will recognize 2 million as a revenue. Now, when to recognize the revenue over time? So there are 3 criteria. Customers simultaneously receiving the benefit. Customer control the assets as created, and asset has no alternative use and enforceable payment right. So in this case, customer controls the site or asset is specific enforcement right to the payments and the revenue over the time using the percentage of completion. So if you remember the previous IS 11, so that was also focusing on the estimation that how much revenue should be recorded based on the percentage of completion method. So if it is a construction company, so you want to recognize the revenue, so you can be recognizing it over the time based on the percentage of completion. In a services companies, engineering consultant, for example, there is a 300 retainer and 200,000 success fee. Now, retainer fee is over the time. So monthly services they are getting. So that is over the time, they will be recognizing it as a revenue for retainership. Same is the case with the accountants who are offering services for tax and bookkeeping to the different companies. So they have the retainership fee. So they will be recognizing over the time. And success fee mean at the end, variable consideration. So recognize only if highly probable. So sometimes some conditions are attached, just like in case of lawyers, that if I win the case, I will charge you extra 200,000. So it means it is a variable consideration depending upon the future event. So if there are high chances that you will be getting it, then you will recognize it. Now, technology and software and IT related services. Standalone selling price or are there, like subscriptions are there, 120,000 a year. Performance obligation. So it's a simple continuous success, revenue is over the time. Software plus implementation. So license, point in time, you got the license of the software at the start. So that is a point in time. And implementation is over the time because it will take maybe 6 months, maybe 12 months. Trading companies, they are providing goods and similarly they are offering the discounts as well. So allocate the discounts proportionately to all performance obligations. So what is a free goods? Performance obligations and allocation of the value over the goods. So sometimes you sell something in a bundle. So again, there will be illustration. I will explain it to you maybe in the next slide. In case of a manufacturing companies, they are producing customized products. So first one is the customized product. Product has no alternate use. Let's say cricket team wants t-shirts for any World Cup or any event. So that is a customized one. So product is not having any alternate use, then enforceable payment terms and revenue is over the time till the contract completion. But if manufacturing company is producing standard products, so revenue at a point in time, because you are selling the goods one time, just like we buy any shirt or anything. So that is a point in time scenario, standard product. But if something is customized, it is specially constructed or produced for any special customer based on the requirements or the customization. So that will be charged over the time if it is time taking. So what is a variable consideration? So fixed consideration, everyone is clear about the fixed consideration. They already know variable considerations. Variable consideration is any part of the transaction price that depends on future events, such as discounts, rebates, bonuses, penalties, refunds, price concessions, performance incentives, usage-based fee, milestone payments. So in this case, these amounts cannot be known with certainty at a contract inception. So we don't know at the start. It is depending upon the future events. So IFRS 15 requires companies to estimate. So it is the duty of the company to estimate the variable consideration and apply the constraint to avoid overstating the revenue. So if there are chances that you are going to overstate the revenue, so you are not supposed to record the revenue. Just like in a lawyer example, there was, I was saying that the 200 extra if I win the case. So it means the word was there that if it is highly probable, then you will record it. So it means the aim is not to overestimate the revenue. So you should consider the chances or the probability of occurrence of that event. So if it is highly probable, then you must record it as a revenue, as a variable consideration. A very important element of IFRS 15, significant financing component. Financing component mean financing cost. So whenever there is any involvement of the significant financing components in the contract with customers, how to deal this thing in the revenue? So first of all, let's understand the meaning. A contract contains a significant financing component if. So what are the conditions? Payment timings provides either financing benefit to the seller and financing benefit to the customer. So general criteria is that if the payment pattern is providing a benefit to the seller or providing a benefit to the customer. For example, if we pay in advance and we get something after 2 years. So it means if I am paying in advance, I will get something after 2 years. So the seller is getting the benefit of utilization of money that I am paying to him in advance. So it means seller is getting the benefit. Whereas in the second, financing benefits to the customers. For example, I get the asset now, I pay in installments. So I am as a customer getting the benefit. So in both of these scenarios, there is a significant financing component. So element of interest, elements of financing cost or financing income. This means you must discount the transaction price, recognize the interest separately, and adjust the revenue to reflect the cash selling price. So what if I will buy something in cash, just like a plot on installment? So if you buy it on cash, the price will be different. But if you are paying over 3 years plan, so the price will be different. So it means there is some financing benefit to the customer. So the customer should recognize it accordingly. And same is the case with the sellers. The seller will recognizing the financing cost and the revenue separately. So let me explain these things with the help of example. So before going to the example, first of all, when does the significant financing component applies? It exists when payment comes much earlier than the control transfer, because the standard was focusing on the transfer of control. So same wording is used here. So the payment comes earlier than the control transfer. For example, advance payment for off-plan property, long-term deposits, upfront IT implementation fee. So these are the three examples in which you are paying in advance. Second, payment comes much late than control transfers. Customer receives goods today, but pays after 2 to 3 years, or maybe the installment plan. So in this case, control is transferred earlier. There is an apartment you are living, but you are paying in installment. So the control is transferred. So customer is getting the benefit of financing. There is an implicit interest benefit, even if the contract does not mention the interest, although interest is not there. There is just an installment price. They said that there is no interest, but there will be some hidden interest. So when the significant financing component does not apply, so some people create a misconception that whenever there will be this type of situation, there are chances that it could be the significant financing components. Now, what are the exceptions? IFRS 15 says ignore the significant financing components when payment timing is for reason other than financing. For example, to protect the customer or supplier. So in this case, it is not a significant financing component. So the intention is to protect the customer or supplier. Second, customer pays retention. In the construction, it is very common that customer has some retention payment. So retention is not again the significant financing components. Payment difference is less than a year. With your installments are ending within a year. So we will ignore the significant financing components. Consideration is variable and timing is uncertain. So again, in this scenario, there will be no significant financing component. The reason is that the consideration is variable as well as the timing is not certain. Customer pays on completion basis, so no financing benefit because customer is willing to pay you when you will complete this order. He is not going to pay you early. So again, this is not a financing component example. Now let's see the example itself. Customer pays 81 million 2 years before delivery. So it means before delivery, 2 years in advance, customer is paying 1 million. Estimated standalone price at the delivery date is 1.2 million. So it means after 2 years, the price is 1.2 million. But he is paying in advance 1 million now to get something after 2 years. So let's see step by step. Step 1. So what is the cash selling price? The cash price at that time is 1.2 million. Customer pays early, the full settlement 1 million. Now the difference is 200,000. Now this represents the interest benefit, basically financing component. So what is the discount rate? Whenever there is a significant financing components, we accountants know that there must be some discount rate. So let's assume the interest rate is 9.5% per year. Now, you will discount the revenue. So the revenue is 1 million. So this is the discounted price, cash settlement now for anything which you will be getting after 2 years. Interest income is recognized over the time. So standard says that if there is such type of things, one thing when you are recognizing, so revenue is recognized and interest income will be recognized over 2 years. How it will be 2 years? For example, we are right now here. So 0 year, 1 year, 2 year. So how much at this reporting date, how much at this reporting date. So let me show you. At the contract inception, year 0, so you will debit the cash. As the control is transferred at the end of the second year, you can see that something will be delivered here. So control is transferred here. So it means at 0 year, you cannot recognize the revenue because the control is not transferred. So it means you will debit the cash, but not credit the revenue. So you will record the liability. So that is a contract liability, or you can say advance. At the end of the first year, your interest will be calculated, which is the financing component, 95,000. So you will debit the liability, credit the income. So now your contract liability becomes 1095. I guess there is some typing error. I will correct it. So liability is going to increase. The liability initially you recorded this one, 1 million. So when you will charge the interest, so it will be the interest expense, not a income. So entry is written in reverse order. So it is expense, credit the liability. So debit the expense, credit the liability. Now your liability is 1095,000. At the end of the second year, now this amount will be at 9.5%. It is this one. So ultimately your liability will become this one. So at the end, when the 2 years have gone, so this is the timeline, year 0, 1 and 2. Year 0, you are recording initial payment. Then financing component. Then again financing component. Now at the end, the total revenue, 1.2 million. So at that time, you will finish the liability and you will credit the revenue, because cash you are not going to receive again. The cash you have already received. So I hope everyone is clear on this. So in this case, there is a significant financing component because the life is more than a year and there is a difference of 200,000, which is almost 20% of the cash you are paying. So it is a significant financing component is there. So significant financing component, the financing portion will be over the time, and revenue will be recognized when the control is transferred. So is there any question now? The loyalty points and all these things I'm coming in the next slides. So just wait a few minutes. Yes, seller's point of view, I agree, Zulfikar. Okay, now real estate developer, if there is an off plan, handover price is 2.5 million. Sorry. Upfront payment 1 million and timing difference is 2 years. So developer must discount the revenue. Upfront payment includes the financing benefit. So that will be recognized as the interest income because you are receiving something in advance. If this is a construction company, mobilization payment, so sometime to meet the working capital needs, customer pays AED 5 million mobilization payment in year 1, work start year 2, completion is year 3. In this case, this is not a financing component because the advance you are paying is not for the asset. It is to cover the mobilization materials. So you can say that to meet the working capital needs. So it will not be the financing component in this case. But if the advance is excessive relative to the work, then it will be the significant financing component. So if it is in advance and not related to mobilization or to meet the requirements of the contracts, working capital, then it will be the significant financing component. IT services, ERP vendor charges 81 million upfront, delivery after 18 months. The cash price at delivery is 1.2. Upfront payment includes an implicit financing element. You can say that there is a difference of 0.6 million. So vendor must recognize the revenue 1 million, recognize the interest income over 18 months. 1 million and 1.2 million. So that is 0.2 million, not 0.6. So 0.2 million is the income. So that interest income will be recognized over 18 months. The reason is that the contract will be completed in 18 months. Sorry. Manufacturing company. Long-term build. For example, customer pays 5 million mobilization in year 1. Work starts year 2. Completion is year 3. This is not a financing component if the advance is required for the mobilization. We have discussed this, but if the advance is excessive relative to the work, then the significant financing component applies. Customer orders customer equipment for 8 million. Payment terms are 10% upfront, 90% after 2 years at delivery. No interest is charged. This means that the seller is financing customer. So seller must discount the deferred payment, recognize the interest income, and recognize lower revenue initially. A trading company, buy now, pay later example. So customer buys AD 300,000 in goods allowed to pay after 18 months. No interest is charged. This is a significant financing component because it is 18 months. So delay greater than 12 months, it is giving a benefit to the customer. So seller must recognize the interest income. So whenever there is any feeling or any recognition that you are having interest benefit or interest cost, so that will be a financing component. So what's a quick recap? Payment timing creates financing benefit either for seller or the customer. It must discount the revenue. Discount mean present value. Recognize the interest separately as income or expense. Indicators of significant financing cost component is the early payment, long-term credit, large timing differences, and implied interest. So these are the indicators of the significant financing components. Now the next concept in the IFRS 15 is the modifications in the contract. So what is the contract modification? A contract modifications occur when the scope, price, or both changes. So sometime only scope changes, sometime only price changes. Many times both things are changed. And the change is approved by both parties. So approval may be written, verbal, or implied. So they discussed in the meeting and they said, okay, fine, do it. There are 3 possible treatments. Modification is a separate contract. A modification is treated as a separate contract if both apply. So what are the conditions to treat it as a separate contract? Additional goods or services are distinct. So they added something new. For example, you are implementing ERP and now you added another company. So a distinct services are there. Price increases reflect a standalone selling price. So they assessed how much is the need of the resources, how much time is required. So they quoted a separate price for their second company. So it means if these things are applied, then this modification will be a separate contract. There might be a construction company, additional floors. Let's say previously it was ground plus 3 for 10 million. Now they decided to additional 2 floors for 6 million. So it means now it will be ground plus 5. So cost is in total 16. So this 6 million, which is for the additional 2 floors. So that is a separate contract because the goods and services are distinct and they are also having the standalone sale price. So it's a separate contract. Contract modifications. Further two concepts are there. Continuation of the existing contract, prospective method, is used when remaining goods or services are distinct, but price does not reflect the standalone price. The revenue from remaining work is recognized prospectively. For example, IT services, you are installing the ERP. Now you requested additional module. Previously, it was not discussed. Client add a new ERP module at a discounted price. So modules are distinct, but not priced as a standalone sale price. So modify the transaction price prospectively. So in future, you will change it, not the retrospective impact. The third one is adjustment to the existing performance obligation. For example, cumulative catch-up is used when remaining goods or services are not distinct. For example, one combined performance obligation and revenue is adjusted cumulatively at the modification date. For example, construction. So they change the scope. Client changes the specification of ongoing work. The entire project is still one combined performance obligation. So in the same, they just change a scope. So cumulative catch-up adjustment will be done, update the percentage of completion. For example, previously you were at 60% of completion. Now they change the scope and you feel that the 10% work is more now. So your percentage of completion will be now 50% instead of 60, and adjust the revenue to date. So now you will be adjusting your revenue that you have recognized to date. So maybe previously you recognized the revenue up to 60%, but now you feel that due to enhanced scope, it should be 50%. So you will recognize you will adjust the already recognized revenue in this case. So if the modification is a distinct and priced as a separate, so that is a separate contract. So if it is a different thing, but the price is not separate, just like the examples of adding a module in ERP implementation scheme. So that is a prospective adjustment. And if it is not distinct, so only a change in the scope of existing contracts, so that will be a cumulative catch-up. So these are the three terminologies that the standard is offering. Okay. Now, as we discussed that in the previous slide, that the contract liability, contract asset. So what is the contract asset? What is a contract liability? When revenue recognized is greater than the amount billed. So in this case, performance has happened, but the billing not yet due. Recognized revenue is 4 million and invoice is 3 million. So it means you have 1 million receivable from customer. So that will be contract asset. Contract liability, when billings are greater than the revenue recognized. So you invoice the customer 5 million and you recognize the revenue 4 million. So it means you have charged more than the work you have recognized. So in this case, there is a contract liability, simple scenario. Another concept in IFRS 15 is cost to obtain and fulfill the contract. So what is the meaning of cost to obtain or fulfill the contract? These are the incremental cost incurred to win a contract. For example, sales commission, brokerage commission, finder fee. Capitalize if expected to be recoverable. So if you feel that these things will be recoverable, then capitalize. And amortize after capitalization, amortize over a period of benefit. So period of benefit mean contract duration. If contract is of 2 years, amortize it over 2 years. But if it is irrecoverable, in most of the time it is irrecoverable, then in that case, it is immediately expense. You will not capitalize these things. Sorry. Cost to fulfill the contracts. These are the costs that relate directly to the contracts, generate or enhance the resources used to satisfy the performance obligations are recoverable. Examples are design fee, setup cost, pre-contract engineering, mobilization. So they are not capitalized. These are the general admin training, wasted materials. So These things are not capitalized. Mobilization cost of 500,000 amortized over 24 million. So if you are spending any mobilization, so if the contract is 24 months project, so you can amortize it over 24 months. IT services, there is an example of setup cost of AED 200,000 for cloud customers. So amortize over the subscription period, maybe 2 year, 3 year, whatever is. So if you have capitalized these things, you can amortize it over the period of the contract or the benefit. Now in the revenue, there is very important concept of principal and agent. So principal entity and the agent entity, nowadays this is very common in many commodities. We are buying from different online stores or different branches of the brands. So there is a relationship between these entities as a principal and agent relationship. So what is a principal? Entity controls the goods and services before transfer. So that is a principal. They recognize the gross revenue, and agent entity does not control the goods and services, only arrange the sale, just like online platforms. So recognize the net revenue. So net revenue mean their portion of the commission. Maybe they are entitled to receive 5%. So they will not record the gross revenue, they will record the net revenue. For example, you are buying Nike shoes from any platform. So you are buying from that platform. So Nike is the principal, that platform is the agent. So agent will recognize only the commission portion. Same is the case with the real estate scenario. Property broker, developer sells a unit for 1.5 million and broker earns 5% commission. Now, broker is recognizing 75,000 as a revenue because he is agent. So when a broker is a principal, if the broker buys units from the developer, then resell them to the customer. So it means now your agent is becoming the principal. Broker has a control on the units. So in this case, broker is a principal. Now he will recognize the revenue at full. And cost of goods sold will be the purchase price at which he purchased from the developer. So what is the indicators of the principal? How we will be identifying that one entity is principal or agent? So if there is inventory risk, so if the person, the company who is taking the inventory risk is principal. Discretion in pricing, who has the authority to change the price. So that is also the principal characteristics. Primary responsibility for fulfillment is also the indicator of the principal relationship. So these are the indicators when we will be identifying either someone is a principal or an agent. Returns, refunds, and warranties. In international market, it is very common that whenever we purchase something, there is a free return within certain time period. So how to record the revenue in this case? Let's say you can return after 30 days. So within 30 days, what entry records it? So how to account for these things? A company must create a refund liability and a return asset as well. So whenever there is a sale on return basis, just like I'm giving you the example of online purchases that we are doing from different platforms, which gave you the facility to return within 30 days, within 60 days, whatever the time is. So in that case, the company must create a refund liability because there are chances that they will be getting refunds. So how they will estimate, they have the past pattern, like if they are selling something, out of these things, how many are getting in return. Even we can see that whenever we buy something, so it was written in the reviews that how many times it is returned and how many times it is kept by the customers. So what is the example? Let's say there is a sales of 1 million, expected returns 5%, and cost of goods sold is 600,000. So how much refund liability should be created? As per the expectation and the data provided, it is written that 5% are expected to return. So refund liability will be 5% of the revenue. So 50,000 is your refund liability. it means you need to pay this. So entity will create this as a liability. Now, whenever some refund will be coming, we need to pay the refund, inventory will be coming back. So that will be the return asset, the inventory that will be returned. Now, that return asset will be based on the cost. So 5% of this will be your return asset. So 5% of this will be your asset. So it means 30,000 inventory is coming to us and liability is 5% of the revenue, which is 50,000. So it means this is your liability, this is your asset. I hope everyone is clear with these things when there is a return policy and refunds are given back to the customers. So entity is recognizing two things, refund liability and return asset. The liability is booked at a revenue into percentage of expectation for the return. And the return asset means the inventory coming back as a result of the sales return. So that will be booked at cost. Warranties. So there are two types of warranties, assurance type and other one is service type. So what is the assurance type? Protects the customer that the product works as promised. So it is not a separate obligation. Create a provision under IAS 37. So IAS 37 will be applicable. As per that, you will be recording a provision for warranty. But if it is a service type warranty, extended warranty, for example, extra 2 years, just like we buy Apple phone. So there is 1 year warranty, that is normal warranty, but there is Apple additional warranty as well for the extra year. So that is a separate obligation. It is not the normal one. So normal warranties are under the normal IAS 37 warranties. You will record the provision as per the provisions guidelines of IAS 37. But if extra extended warranties, then it is a separate performance obligation. So entity will record it separately, allocate the part of transaction price, recognize the revenue over warranty period. So that will be extra months. Example, laptop sold for 4,000, 1 year assurance warranty. So it is part of this 4,000. Now 2 year extended warranty, 400. So this extended warranty is a separate obligation. So revenue is recognized for this over 2 years. So this 400 will be recognized over 2 years as a separate performance obligation. So it is a revenue over the time, not a point in time. The point in time revenue is 4,000 and warranty, normal warranty will be treated as per the IAS 37. So I hope that these things are also clear, which are very common in our today's buying patterns. Now, disclosure requirements in IFRS 15. So what are the notes to the financial statements? Disaggregation of revenue. So disaggregation mean breakdown by categories. For example, if you are a property related company, real estate, construction, services. How much revenue from real estate, how much construction, how much services. If you are divided into geographical areas, so your revenue should be area wise. Types of the contracts, timing, point in time, over the time, market or customer type, payment terms, advance payment, retention, milestone, sales channel, online, distributor, direct. Now, it does not mean that you need to disaggregate the revenue in the P&L. You will record the revenue as per the guidelines of IFRS 18, but in the notes, you should explain these things. Contract balances. So you must disclose contract assets, contract liabilities, changes in the balances, like what was the opening, then what are the changes. Revenue recognized, prior liabilities. Then if there are significant judgments, so you need to explain the judgments about percentage of completion, identifying the performance obligations, variable consideration if there is any, principal and agent relationships, timing of the revenues, and remaining performance obligation if there is any backlog amount of the contract revenue not yet recognized, expected timing within a year, how much, from 2 to 5, how much. So you need to describe these significant judgment as well in the notes to the financial statements. If you are recognizing the asset to the cost to fulfill and obtain the contracts, because I have explained to you that cost to fulfill the contract, then the cost to obtain the contract, how much commission, fee, incentives, cost to fulfill, it should also be explained in the notes. Then required disclosures, closing and opening balances, amortization method, because we said that it will be amortized if you are capitalizing irrecoverable commissions and fees. If there are impairment losses, so impairment losses will also be recognized. And reasoning behind the capitalization, if you are capitalizing something, if you are not, then it's okay. Expected period of the benefit. Now, practical expedients if used. Companies must disclose if they use the IFRS 15 practical expedients. So what are these things? The same significant financing components, incremental cost of obtaining the contract, and remaining performance obligations. So in the notes to the financial statements, these things should be covered. Policies and accounting methods. Revenue recognition, accounting policies, method use, treatment of the contract modification, how you treated the modifications, then treatment of the refunds and returns, how to discount the allocation is done, and when the revenue is disaggregated. So you need to disclose these things in the financial statement. So I hope that it is clear. Now I can check the questions.
Yes, Ayaz, I can read some question for you. So I have noted on from the chat box. So
Okay.
maybe it can help us. So first question, this is from my side actually, and that is if we are using POC in the contractual in the construction industry. So there are two types of certifications. One is certified revenue and uncertified revenue. So which revenue we should use, or which work done we should use for the percentage of completion in that case?
Certified, because the aim is to improve the transparency. So reliability and transparency prefers to have a certified one.
Yeah, right. In that case, then there will not be any difference between revenue and liability.
No problem. There is no condition that there must be some difference. So
Okay,
it's
right. Thank you. Thank you. The next question is when the cost be recorded, if the control jet not transferred, then what will happen? This is Abu Bakr asked this question in the chat box.
if you can repeat, what is the question?
When the cost be recorded, if the control jet not transferred.
Cost
control
is
is not
recorded at the time of incurrence. You will record it. You cannot delay your expenditures.
Okay.
So the
So in that
cost will
case,
be recorded.
matching concept will be compromised if we are recording cost and revenue. We are not
So you can
recognizing in the
record the
same time.
contract asset. You can record the contract asset. So you will record these things like cost is incurred. So you will record the expenses, and at the end you have a receivables. So that is a
Fine,
contract asset.
perfect. Yeah, hope it is cleared for the Abu Bakr also. Then the next question, Anil Ahmad asked, he said, please define the loyalty point treatment. So in some cases, we are earning loyalty points.
Yes,
Yes.
loyalty points means that there are some points available. So right now I was thinking that there is an example available, but I guess I missed that. And in this system there is not no example is available right now immediately to show. But the loyalty points, let's say you are recognizing loyalty points equal to 1% that you are selling, so your points are accumulated. And it is just like the discount you are offering. So you will record the provisions for the discounts. So that is treated as a discount.
Right. Good. Thank you very much, Ayaz bhai. The next question Zulfikar asks, and he's asking if cost is recoverable, it is relating to your example you have given for the recoverable cost. He's saying if cost is recoverable, why we will amortize that cost? So we can recover. So why we are amortizing in that case? So I think he's
Actually,
confusing. Yeah.
the principle behind this is that I don't know whether it will be recovered or actually recovered. I have the hope that it will be recovered. So, but you have incurred it. So, for the time being, you will amortize it.
Yes. So then there is a question from the Sayyid. He's saying full entry for the refund, if you can explain to him.
For the refund.
Yeah.
Okay.
You have in your slide, I think he's missing something.
Yes, I have. Yes, this one.
Mm.
So I told that there is a revenue of 1 million. Expected returns are 50%. Sorry, 5%. So the refund liability will be recorded at 5% of the revenue. So 50,000 is this one. And return asset will be booked like the inventory you are receiving. So you will record the asset. So you can say that return asset debit 30,000. You will credit the return liability 50. Now the difference is 20,000 in the debit. So that is the balancing figure.
Right.
So
Oh.
this, yes, please.
Yeah, so hope this is clear for him also.
Yes, yes. So the difference will be like provision for returns. So basically, it will adjust your profit when it will be actually coming back to you.
Right. And then there is a question from Mudassar, and it is relating for manufacturing industry. He's saying same scenario can be used on the return policy for finished goods. I'm not getting what he wants to
Yes,
understand.
same.
If you are getting
Like if something is standardized and it can be returned, so this is same. But for the customized one, there is no return policy. So that you are making it specially for to meet a customer's order.
Right. And then I'm reading from the chat box. Ali Asadullah asks, do we need to mention income on our sales invoice as different Incoterms have different treatment of revenue recognition?
No, not in the invoice. This is our internal
Yeah.
revenue recognition policy. No need to mention on the invoice.
Yeah. And then there is from Muhammad Ramzan, as per IFRS, is uncertified revenue can be taken as revenue. And the second question is when make shipment can we book the revenue or wait until it reaches to the customer warehouse and we will get signed delivery note.
Basically, the standard says that control is transferred. So in this case, if there is a condition that you will be providing it to the customer's premises and the seller is providing it, so it means the control is not transferred till that stage. So in that case, it is not to be recorded as a revenue. So it will be the goods in transit. But if the control is transferred at the shipyard in the other country, so if the responsibility of the seller is to deliver it to that yard, so it means at that stage he has delivered. Now he will assume that the control is transferred to the customer. So it depends upon the promise the seller is doing with the customer. So if the promise is to deliver the items safely to the customer's premises, then the control will pass when it will be delivered to the customer. So accordingly, the control is passed, you will record the revenue.
Right, absolutely right. And the last question Tayyib asks, can you please explain SFC again, please? It is very well explained,
Significant
Tayyib.
financing component,
Yeah.
I guess this question was asked later, but later on I have explained it in detail. Okay.
I think if you will go with the this presentation, it is very well explained, Tayyib. But sir, if you can, in within 1 minute, quickly to wrap up this one, because we are short of time as well.
What What is to be wrap up in short time?
I'm saying we have still IFRS 13. So this question, the
Yes, yes.
final
So
question will
from
be
my side,
briefly.
IFRS 15 is done. Now the next is IFRS 13. Inshallah, I will try my level best to complete it as well. So let's
Inshallah.
start with IFRS 13, fair value measurement.
Yeah.
Now, this standard is not actually giving you where to apply the fair value measurement. The rules are in other standard. This standard explains that how to calculate the fair value measurement. So objective and scope of this standard define the fair value and provide a single framework for measuring and disclosing it. So how to calculate the fair value? This is the scope of this IFRS. IFRS 15 applies whenever an other IFRS requires or permits a fair value. So it means this standard is not giving you an idea that where to apply fair value. So whenever you are supposed to apply the fair value, you will follow this rule. Now, a fair value or a fair value less cost to sell or fair value less cost to disposal or the current value, that is essentially a fair value. Now, which standards requires application of the fair values? So they are these standards. For example, IS 40 investment property. So it recommends fair value model. IFRS 9 is also recommending fair value through profit and loss and fair value through other comprehensive income. IFRS 3 business combinations. So it is also recommending the fair value. Business combination is our next series as well. In impairment, there is also a concept of recoverable amount. In IS 41 biological assets. So it is also requiring the fair value model. IS 16, IS 38, so it is revaluation model is also linked with the fair value. IFRS 5, fair value less cost to sell or a discontinued operation. So all these standards require fair value models. Now, IFRS 13 will tell you how to calculate fair value. What IFRS 13 does not tell you when to use. So as I explained you, this standard is not telling you when to use. So it is the requirement of other standards to follow the fair value. So this standard is not giving you any rule that use fair value in this case, in this case. So these things are not in the scope of IFRS 13. It only tells you how to measure and what to disclose. So what is the definition of fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability. So if you are selling an asset, you will receive the money, how much you will receive. So if you are settling a liability, you will transfer the money in order to transaction between market participants at a measurement date. So because we know that when we change the date, the rate change. So fair value is the current market based price of any asset or a liability. It represents what you would receive today if you sold an asset and what you would pay if you will settle a liability. The price must come from an orderly transaction, meaning not a forced sale, not a distressed transaction. Both buyer and seller have enough time and the information. It must also be based on the assumption of the market participants, not your own assumptions. This means fair value reflects how the market would price it, not how your company wishes to price it. So just like there is a concept of arm's length transactions, that fair market price when both seller and the customers are exchanging the goods and services with a certain knowledge and experience. So all these criterias which are reflecting the amount to be received or to be paid. In case of asset, it will be received. In case of liability, it will be paid. So all these should be based on the market price. So if this is the scenario, this will be known as fair value of that asset or a liability. Now, what are the key concepts in this IFRS? Unit of account, defined by the standard requiring, for example, individual shares, block of shares, or CGU. If you remember the IS 36 that requires cash generating unit, how to calculate the impairment of CGU. So it is basically the requirement of the standard that how you will be applying the fair value, whether to individual stock, whether a block of shares, whether a CGU. Important for control premium, discounts of our lack of marketability. And market participants mean independent, knowledgeable, able and willing to transact. So they should be of these characteristics. The participants mean the buyer and the seller. So what is the assumptions? Maximize the economic benefits, use the highest and best use for the non-financial assets, principal market versus most advantageous market. So what is the principal market concept? Greatest volume and level of activity. If no principal market is there, so it means you will be use most advantageous. Best net price after transaction plus transaction transport cost. An entity have access to that market at the measurement date, but not necessarily transact there. Highest and best used if it is a non-financial asset. So fair value assumes that the assets use at its maximize its value. In use mean value comes for the combination with the assets, other assets. For example, if it is a factory, there are machines. So in combination, how much value if you will be using it. In exchange value as a standalone. If you will sell this one, how much is the value? So highest and the best use must be physically possible, legally permissible, and financially feasible. Liabilities and own equity instruments. Fair value assumes that the liabilities or the equity instrument is transferred to a market participant not settled or cancelled. Considers the non-performance risk, including the own credit risk. If no observable market is there, then use the perspective of the counterparty, for example, valuation of the derivatives and decommissioning of the provisions. So I will explain these concepts step by step. As per the IFRS 13, there are three levels of the fair value hierarchy. Level 1, 2, 3. Level 1 means quoted prices in the active market for identical assets and liabilities. For example, listed equity shares on active stock exchange. So it means there is active market means frequently the transactions are done. So this level of fair value will be the level 1 fair value. With active market, with identifiable assets and the liabilities, their prices are quoted. Level 2, observable input other than level 1, for example, quoted prices for similar assets. Here it was identical, same, 100% same. Similar mean almost same. Interest rates, curves, and the credit spread. So if it is a bond, so in that case, there will be interest rate on the similar bonds. Level 3, unobservable inputs. So in that case, there will be the management assumptions and internal models. So level 1 is the most best possible situation. Then level 2 and level 3 is the least possible for fair value calculations. So in that case, management assumptions will be used. Then active market criteria, transactions occur with sufficient frequency. As I told you that there are a lot of transactions and volume to provide the pricing information on an ongoing basis. So it means on daily basis, you are having this. Transfers between levels. For example, one thing is transferred from level 1 to level 2, level 2 to level 3. So how this transfer will be dealt? Based on the change in the observability of the input, for example, bond becomes liquid. So the level 2 to level 3 important document when and why to reclassify, when and why this reclassification occurs. So level 1, level 2, level 3, there are 3 levels of the fair value measurements. And sometimes your bond or your shares is classified from one level to another. So how to deal with these reclassifications? As far as the valuation techniques are concerned, there are 3 approaches as well. Market approach, which uses the price, relevant information of the market transaction for identical or comparable assets. For example, quoted equity, market multiples, these ratios, you can use price earning or EBITDA ratio. Income approach. Income approach mean how much you will be receiving. For example, if you are buying a share, so income approach mean how much dividend you will be getting. From the bonds, how much interest you will be getting. So convert the future amounts, which are the cash flows or the income or expenses, into a single current amount. So which method you can use? Discounted cash flow. So present value of all future benefits. If it is a share, from now onwards. So if it is a timeline, you purchase something here. So you are going to receive dividend annually up to infinite year. So it means we have an assumption that the business is a going concern. So then there is no intention to close the business. So I am expecting the same thing, that I will be getting the future dividends till the infinite time period. So it means all the future benefits must be discounted based on income approach to calculate the fair value. I'm not going in detail how to calculate that. Cost approach, which is the current replacement cost less any depreciation or obsolescence. For example, specialized equipment, if there is any. So if there is any obsolescence, you can subtract that. Choosing the techniques, use the techniques appropriate to the circumstances for which the sufficient data is available, and often multiple techniques and the weights are there. What are the inputs and assumptions? Observable and non-observable. Observable mean which we can easily observe. Examples: discount rates, risk-free plus premium. So whenever we use any discount rate, so that discount rate must be appropriate discount rate. So if it is a bond, you can say that it is a risk-free rate of return should be there for discounting. But if you are taking a higher risky bond, so it should be adjusted for the risk premium. Growth rate should also be considered in valuation, volatility as well, and if there is any correlation between any future events and uncertainties, so that should also be considered in valuation. Then the next concept is collaboration. When you require an asset in a market transaction, for example, purchase price allocation, you often collaborate your valuation model to the transaction price on day one. Subsequently, update only for the changes in observable market or the data or entity specific variable. So on the day one, you will record everything as per your best estimates. And then in future, if there is anything which is affecting the entity or its performance or any future cash flows, so you will be adjusting these fair values. Measurement issues and advanced topics, day one gain or loss. If all the inputs are observable, recognize day one any gain or loss. If some inputs are unobservable, often restrict day one gain and loss. So if you are not sure, then you are not going to record it immediately. Block the discounts and control premium for level one. Cannot adjust the quoted price for block size. Use the quoted price for the entire holding. And for business combinations or investment in the subsidiaries, may have a control premium included in the transaction price, just like you are paying extra. So in the consolidation, we used to have it as a goodwill. So that is a premium. Control premium mean you are getting the control. Maybe you are paying extra to acquire a certain number of shares. Non-performance risk and own credit risk. So non-performance risk and own credit risk, these are very important. We will discuss these in detail. Fair value of the liability incorporates the risk that the entity will not fulfill the obligation. So if the entity is not able to pay, so it is known as own credit risk. Relevant for issued debt, return derivatives, and counterintuitive effects, for example, deterioration in own credit risk may reduce the fair value of the liability again in the P&L. So if your liability is reduced, it means you are getting a gain. So we accountant know that if something is to be paid like 1,000, but your ability to pay is reduced, then I will explain that how to do this valuation. So when it is done, so it is a gain to the entity. So reduction in the liability is treated as a gain, and reduction in the asset is treated as a loss. And then there is a concept of bid-ask spread. Fair values can be written the bid-ask spread. For example, when we buy something, maybe the foreign currency, so bid price, ask price is different. So there is a difference between bid and ask. And entities often use the mid rate or another convention must be consistently applied. Portfolio and offsetting for certain financial assets and the liabilities managed on a net basis, IFRS 13 allows the portfolio exception. So what are the exceptions? Measure the fair value on a net risk exposure basis. For example, derivatives with dealer. Consider the credit and funding adjustment. So that is a credit valuation adjustment and debit valuation adjustment. So I will explain this in detail. So what is the credit valuation adjustment? What is a debit valuation adjustment? So credit valuation adjustment is a downward adjustment to the fair value of a derivative asset to reflect the counterparty's credit risk. So let's say you have some asset with you, some bonds of the other entity, and you feel that that other entity is not performing well, they will not be giving you the promised return. So if there is a case, you will not be getting the promised return. So it means you are going to lose the value of your asset. In simple words, if you have a financial asset, for example, receivable from a derivative contract, and there is a risk that the other party might default, you must reduce the value of that asset. Why? Because the fair value must reflect the market participants would consider, including the chances that the counterparty may not fully pay. For example, if the worth of your asset is 1 million and the counterparty has a 5% default risk, so it means there are 5% chances that it will be defaulted. So IFRS 13 requires to reduce the value as a credit valuation adjustment. So 5% means 1 million's 5%, you will reduce your asset. So reduction in asset is expense. So credit valuation is basically the adjustment of the counterparty's credit risk. So it means the counterparty is not able to pay you. So that is a credit valuation adjustment. And what is a debit valuation adjustment? It is our own ability to pay any obligation. So let's see what is DVA, debit valuation adjustment. Debit valuation adjustment is an upward adjustment to the fair value of a derivative liability to reflect your own credit risk. In simple words, if you owe money on a derivative liability and your own credit worthiness is not perfect, the market would assume that you might not pay 100%. So it means the liability's fair value is reduced, meaning to add DVA adjustment. So why? Because IFRS 13 requires to reflect the prices at which the liability would be transferred, including the risk you might default. So let's assume the same thing. There is a liability of 1 million and there are 3% chances that we will default. So it means 3% will be adjusted for the debit valuation adjustment. So what is a credit and what is a debit valuation adjustment? So I hope everyone is clear. Debit valuation adjustment mean to adjusting our own credit risk that we will not be able to settle the liability. And if the counterparty is not able to settle the liability, so that will be the credit valuation adjustment. So this debit valuation adjustment is reduction in the liability. So it is a good thing. Now, if it is a good thing, everyone will do it. No. This is allowed only for traded item like stocks, like bonds, which are traded. So you and your ability to pay is also assessed by the credit rating agencies. You cannot assume by your own self that my ability is now less. So otherwise, everyone is showing this thing. So what is the summary? Applies to derivative assets and debit valuation is applied to liabilities. How you can remember that credit in asset mean you are reducing the asset. Debit in liability mean you are reducing the liability. Both adjustments are reducing. So credit adjustment will reduce the asset, debit adjustment will reduce the liability. So as a result, value is reduced in both cases, and this debit credit adjustment will be reflecting counterparty's risk, and this is our own credit risk. As a result, what is the effect on fair value? The fair value of asset is decreased and fair value of the liability is decreased. So fair value of the liability decreased mean profit, and fair value decrease in asset mean there is a loss. So what are the disclosures required as per IFRS 13 when you are following it? How fair value is measured? This thing is important. Which inputs and valuation techniques were used? And how much of the fair value is based on observable and non-observable input level 1, level 2, level 3? How the fair value affects the profit and OCI and sensitivity of changes in the assumptions and transfers between the levels. So now one by one, I will explain these things. Disclosures of the assets and liabilities measured at fair value. So if you have any assets and the liabilities which are measured through fair value, as per this standard, you need to disclose the fair value hierarchy of these assets, which of them are level 1, level 2, level 3. And if they are transferred between any level, so what are the reasons, what are the timing? So these things should be disclosed related to all the assets and the liabilities which are measured through fair value. Valuation techniques, which method you are using, we have discussed these methods, that market approach, income approach, cost approach, input based. So these methods will be used. So which method you are using, you need to disclose it in the disclosures. There are some additional disclosures as well, and which are particularly related to level 3. As I told you, level 3 was the worst one. Level 1 was the best one. So reconciliation of the level 3 fair values. This is the special requirement for the level 3 fair values. What is the opening balance? What is the total gain or loss? So purchases, sales, issues, settlement, all these things should be disclosed, particularly related to level 3 fair values. And plus which line item in P&L or other comprehensive income, because we know that some of the fair values are having effect on the profit and loss, just like IFRS 9 we have discussed last time, that you can classify your shares and bonds either through P&L or OCI. So what are the criterias we have already discussed. So you need to disclose these things in your disclosures. And if there are some unrealized gains, like as per the IFRS 9, if you have classified any financial asset as a fair value through other comprehensive income, so at the end of each reporting period, you recognized unrealized. Unrealized mean you are not selling the asset, but based on opening closing prices, you are recognizing a gain or loss. So this should also be disclosed. And description of the valuation process, explain how the entity determines the fair value, who performs the valuation, is there any valuer or is there any qualified one, the use of the specialist, if you are engaging any specialist, frequency of the valuation, how the inputs are selected and validated, and significant unobservable inputs. If there is any significant unobservable input, identify the input, discount rate, credit spread, growth, EBITDA, and these things should also be disclosed in the disclosures, especially related to level 3 fair values. Sensitivity analysis should also be in the disclosures to explain how sensitive the fair value is to changes in the unobservable inputs, effects of the reasonably possible changes in the each significant input, whether the inputs are correlated, and quantify the impact on P&L and OCI. So what are the disclosures for assets and the liabilities not measured at fair value? So if you are not measuring any assets and liabilities at fair value, then what to disclose? Investment properties, if they are at cost model, then there are certain requirements. And if they are at fair value, then disclose the fair value, level of hierarchy, valuation techniques, input, reasons for transfer between the levels. So if it is a cost model, then the disclosures of IS 40 will apply for the investment property. And fair value measurement at initial recognition. So if you are measuring anything at fair value, so what is to record initially? So if the transaction price is not fair value, explain why. If there is a difference, but normally if it is same, then the market price is considered to be fair value. But if due to any other factor market price is less than, so you need to explain the reason. Describe the evidence supporting the fair value and describe the valuation techniques you are using. And disclosures for non-recurring fair value measurements, for example, fair value used only when impairment or revaluation happens. So in order to these non-recurring fair value measurements, you need to disclose what event triggered the management to do the fair value this time, level of hierarchy, valuation techniques, input and assumptions. Unit of accounts and the classes of assets and liabilities. Entities must disclose how the assets and liabilities are grouped into classes for disclosures, how the class differs from line items in the balance sheet, and disclosures for the liabilities and own equity instruments measured at fair value. So just like we were discussing at debit valuation, that sometime you need to adjust for your own assets and liabilities. If the liabilities fair value reflects the effect of a non-performance risk, disclose how the non-performance risk, including own credit risk, it might be other entities as well. So when DVA was included, related assumptions as well. And if the third party use of the third party pricing services, if you are using for fair value, like building valuations and any other assets, you are getting the valuers report. So if you are using the third party for these valuations, if the external valuers or the pricing services are used, disclose their role, whether the inputs are adjusted, and how the reliability is assessed. So how you assess that they are reliable. So you need to certify them. So that's why most of the cases certified valuers are preferred. And fair value of the collateral. If there is any collateral, if the fair value relates to the collateralized asset or liability, describe the nature and fair value of the collateral. And when collateral can be used or sold. So if there is any guarantee or collateral is there, so you need to assess that. So what is the summary of the disclosures? Fair value for each class for all levels. Valuation technique for each class, input used, transfer between levels. If there is any transfer from level 1 to 2, 2 to 3, or 3 to 2, so that should also be disclosed. Level 3, reconciliation is also there. So it is only applied to level 3. Unrealized gain and losses is also for level 3. Sensitivity is also for level 3 only. And valuation process description, level 3. Fair value versus transaction price when there is a difference. Otherwise, in normal condition, the transaction price is assumed to be fair value. But if it is different, then you need to disclose. Collateral disclosures, if they are relevant, it should also be disclosed. And non-performance risk debit valuation. So in case of liabilities, if your ability to settle the liability is reduced, then you will do a debit valuation adjustment. So that the people can know that your credit worthiness has affected your liability to settle the your ability to settle the liability. Now, what are the typical application areas? For example, banks and the financial institutions, trading portfolios level 1 and level 2. So listed equities level 1, government bonds are also level 1, level 2 if priced using the yield curve. Over the counter derivatives is also the level 2 liabilities. Illiquid bonds and the structured products use the pricing model, estimate the cash flows, discount using the yield curve, and if key inputs are there, then the credit spread for the borrower are not observable. So in that case, it will be the level 3 fair value. And the loans measured at fair value through profit and loss. So use the discounted cash flow to have the contractual payments, and then you will be using the discount rate. It could be the risk-free rate if it is a bond, but if there is any risk associated regarding liquidity and credit spread, so you need to adjust it with the risk associated with that. Incorporate non-performance risk from the borrower's perspective, and practical measures at reporting date. So what is the practical measures? Updated yield curves you must have, foreign exchange rate should be there, credit spread should be there, identify the securities with how trading volumes, and check if the level 2 is moved to level 3. So if there is any transfer between the levels of the fair value, so you need to take care of these things. Investment property at fair value, if you are using investment property, a real estate company, so you can use the fair valuation for market approach or income approach. So which method you are using. Then market rent, you can use vacancy rate, cap rates, discount rates. So these are some practical indicators that you can use for the fair valuation calculation. Then the development properties, you can use the discounted cash flow for the land, construction, infrastructure, and the selling cost. Cash inflows, sales rates, selling prices, payment plans, and highest best use information as well as described earlier. So what are the practical measures at each reporting date? So as you need to adjust the fair values. So first of all, collect the updated market data, recent sales, yield, rents. So whatever is your scenario in case of a real estate, revised budgets, progress for the project, percentage of completion, all these things you need to get at the reporting date so you can recognize the fair values of these things. Engage or review the external valuer, ensure the valuers are independent and qualified. So they must not be your employees, so they must be independent and qualified to do these valuations. And challenge the assumptions that if they are saying that the value is this one, so you can raise counter questions to challenge their assumptions for the valuation so that you can satisfy their valuation, and document the valuation method selection and the reason, and sensitivity analysis of plus minus 5.5 or 5%, whatever is recommended in the industry. Now, if you are a manufacturing company, you are using property, plant, and equipment. So fair value model is used if you are using this one. So fair value is usually based on the market approach. So market comparables or the cost approach if you are using. Then specialized equipment, often cost approach, replacement cost, less physical and economic obsolescence. And if you are having asset held for sale, so these are the asset we classified as held for sale as per IFRS 5. So it should also be through fair value. So it should be measure of the lower of carrying amount and the fair value less cost to sell. So again, fair value is there. So you need to disclose these things. And biological assets as per IS 41, they are also measured through fair value. So use the market price of the livestock and the crops and discounted cash flow to expect the harvest. And practical measures at each reporting date, in this case, manufacturing companies. Identify whether any property, plant, and equipment revaluation is required. So if there is any material changes versus last valuation. So if as compared to last year, there is some material change, so you need revaluation. Obtain the updated valuations for the asset held for sale with active sale plans. So as IFRS 5 says that you must be in search of active buyer so that you can anyone can buy your asset. Otherwise, not just to classify it is not sufficient. For biological assets, updated market prices of the livestock and the crops. In case of business combinations, purchase price allocation, IFRS 3, identify the assets and liabilities at fair value, tangible assets, how much you are getting, intangible, so that is part of goodwill. Valuation methods, so relief from the royalty, multi-period excess earnings methods. If there is a case that in case of future earnings will be this one, so there is a also allow adjustments. With and without method for software, and goodwill impairment. If in a business combination you are recording any goodwill, so it should be impaired as per the provisions of IS 36. So that is a separate thing. So we know that it should be every asset should be at recoverable amount. So recoverable amount is the higher of value in use and fair value less cost of disposal. So value in use mean if you will be using anything, let's say that is a overall factory. So if you will use it, you will get a value of 1000. If you will sell it, you can sell it at 1100, but cost to sell is 200. So what is the net effect? 900. Now one thing is 900, one thing is 1000. So which one is higher? So higher one is known as recoverable amount. So the recoverable amount will be 1000. So you will compare the recoverable amount with the book value. So if the book value is higher, let's say the book value is 1200. So it means your assets are not showing the recoverable amount equal to your book value. So there is a need of impairment of 200. So this is a very simple explanation of the impairment as per the IS 36. So whenever we are applying the fair values, so fair values are also applicable under IFRS 30, IS 36, not IFRS. And if you are doing the impairment of a cash generating unit, so fair value less cost to disposal, updated market multiples, discount rate, budget. So all these things as per the provision of IS 36, you will be following to calculate the fair values. Okay. So implementation of the framework from the company's point of view. So what are the steps? Step one, identify all the items measured at fair value, work with the chart of accounts and each IFRS standards. For example, if there are some financial assets and liabilities which are under IFRS 9, there are some properties which are under IS 40, which is investment property. The aim is to get rentals or to get capital gains. So these properties will be investment properties. Asset held for sale, if you have classified anything as a held for sale, you must know. And then biological assets, then revaluation of property, plant and equipment, which is normal IS 16. And if there is any cash generating unit and there is chances of impairment. So at the end of each application of this fair value model, the first step is to know that in your chart of accounts, how many assets and under which standards, and which standards require fair value calculations. Then step two is to determine the unit of account, whether it is single asset, portfolio, or CGU, principal or the most advantageous market approach which you are using, and then level of their fair value hierarchy, who does the valuation, internal or external. Then step three is to data and the model for level one, level two, level three. So what is your model? You will be adjusting the fair values based on your data and the company scenario. Then control and the governance. So there must be the segregation of duties, front office versus valuation versus accounting. So everyone should be having their own role. Valuers should not be dealing with the accounting entries and these things. Independent price verification should be done. So sometime accountant is doing the valuation. So that is not recommended at all. And regular review of the valuation methodologies in input, including the challenge process and internal audit and external audit integration as well for fair values, because your fair values will be presented in the financial statements. So what are the pre-closing planning? So update the fair value inventory if you have any, then determine the timetable and the responsibilities. Then data gathering and assumptions. So what is the market-based data, entity-specific data, and checks for the indicators of that might change the hierarchy. So all these points are just theoretical points. You will just go through these things when you will get the slides. Otherwise, you can review these from the regional standard as well. So if there is any valuations, we have already discussed that you will run the valuation model in your system, and then you will cross check whether your system is accurately calculating these things, and if there is chances of any variation. So you will apply the sensitivity analysis in the valuation. For example, plus minus 1%, growth rate of plus minus 1%, cap rate of 0.1% or 0.5%. and document the impact on fair value through P&L and OCI. So if your asset or liability is routed through P&L, so impact will be in the P&L. And if it is routed through OCI, so it should be from OCI. Then review and the governance. So it means the accountant is not only responsible for the changes in the fair value, there must be proper system who is assessing the fair value, from where the data is gathered, who is responsible for posting these impact to the financial statements. So accounting and disclosures, as I told you, that if it is fair value through P&L, so it will goes to P&L for trading items. For example, shares you purchased with a trading purpose or bonds you purchased with a trading purpose. So that is a P&L item. And if your aim is to get contractual cash flows as well as sometime capital gain, you can sell early. So that is fair value through OCI. So you will be implementing all these things as per your classification, prior classification. And disclosure preparation, what fair value hierarchy, same level 1, level 2, level 3. So if there is a level 3, reconciliation will be done. And audit support package mean you will be providing a model without flaws. You will be having certain segregation of the duties, who will be doing these valuations, who will be posting these, and who will be the authorized one to show the impact finally on all these things. So this was all related to IFRS 13 and IFRS 15. So now if there are any questions, you can ask.
Yeah, there is only one question for IFRS 13. And Anil Ahmed asks, he's asking, if we transfer assets from IAS 16 to IAS 40, what is the treatment and how can we get the fair value of the asset?
It is basically the scope of IAS 16 that if you reclassify it from cost model to revaluation model, so you need to follow the IAS 16 rules. The IAS 16 rule says that from that date, whatever the depreciation you have charged, you need to finish it from the record. So you will do the debit, the accumulated depreciation, and you will assess the fair value on that date. And now from onward, at the end of each reporting date, you will be assessing the fair value of that asset. And accordingly, the fair value gain and losses will be recognized in the future periods.
Great. And it was really very insightful session. And it is really, I will say, you presented both the IFRS. This was very impressive. Thank you very much for your valuable time, and hope the next session will also be the same interesting as
inshallah.
it was
Today,
today.
I was not in a good thought, so I was feeling down
No,
as
it was
well.
very good. We didn't feel this. It was
Yes,
really
I
very
tried
impressive.
to camouflage my feelings.
Good one. And I would also like to thank our teams of branch consuls, UAE branch consuls, Saudi branch consuls, and Canada branch consuls. They brought you here for us. Thank you both, all three teams. And at the end, I will call Chairman of UAE branch consul, Rizwan Bhai. It's to you and for your thank you note. So please go ahead.
Assalamu alaikum. Thank you so much, Mr. Sayyid Fahim Jafar Sahab. On behalf of the UAE Branch Council, I extend my warmest congratulations to you and the entire team of TSPD for successfully organizing back-to-back series of webinar on IFRS. Definitely special thanks to our honorable speaker, Mr. Ayaz Mustafa, the shining star of ICMA International, for his valuable time and insightful detailed guidance on IFRS.
Thank you,
I'm
sir.
also grateful to all the branch council for this collaboration that we are doing webinars together. Mr. Siraj Ahmed Ansari, the chairman of KSA branch, Sayyid Zia Mehboob, chairman Canada branch, and Mr. Ghulam Mustafa Qazi, our president, chairman TSPD committee and national council member. who have joined and contributed to the success of these TSB webinars. My sincere appreciation goes to all the members who have joined, and I will not forget to say congratulations, the support of our colleague and the team of head office, especially Mr. Shams, Ms. Hira, Mr. Asim, and Mr. Shafiq and his ID team for their valuable support in making the event very successful. Once again, thanks you all for making your efforts and making all our events very successful. Back to Mr. Syed Fahim Jafar Saab.
Fahim bhai, you are muted.
Sorry. Yeah, you can hear me now. So thank you
Yes.
guys. And especially now, thank you all the participants who has sent us questions. Those are also very useful and valuable. So obviously the star is our today's speaker, Ayaz Bhai. All of the team is also thank you very much. So good night. Have a nice day tomorrow, weekend. So enjoy your time. Thank you very much, guys. Allah
Thank
Hafiz.
you. Bye. Allah Hafiz.
Thank
You
you.
all. Thank you so much.
Thank you.